Hello, everyone. My name is always Asmal. Welcome to another episode of Two Ways to Skin a Cat, a show where we talk career experiences, entrepreneurship, and investments. The main aim is to show that there's more than one way to be successful other than climbing the corporate ladder. We are live on LinkedIn, on YouTube, and the show will be available on podcast by tomorrow morning. Don't forget to like, subscribe, and click on the notification bell to get automatically notified when the next episode comes out. If you're joining us live, please drop a one in the comments and drop a two in the comments if you're watching the recording. My guest for this week is Abdul Davids, a certified financial analyst, head of research and portfolio manager at Kagiso Asset Management. Abdul, thanks so much for joining me today.
Thank you, and my pleasure.
Let's jump straight into questions. Maybe tell us your story, where do you come from, and even outside of work, who is Abdul Davids?
Yes. Okay. Again, thank you for the opportunity. When I normally ask my interviewees that question, they start off with where they grew up and school career and all of that. I think we don't want to bore your viewers with that. And I'm basically the portfolio manager of the Kagiso Islamic Funds and portfolio manager for institutional clients. But I'm also a COVID survivor. I had COVID in August and came through that. And I think, in a nutshell, my background is born and bred in Cape Town, studied at UCT. As you said, we don't only try to climb the corporate ladder, but obviously have gone through that process as well. And I think I've got my calling in life in terms of both managing client funds, but also trying to bring Sharia compliancy to the Muslim community of South Africa. I think that is quite a big calling, and it's something that I'm quite passionate about as well. Yes.
And outside of work?
So, as you know, we belong to the same running club. So, Omidrike running club. I'm also a cyclist as well. Not that I look the part, I must add, but I do think that, yeah, it's quite important to balance life in terms of work and also social activities, keeping fit, healthy mind in a healthy body, all of those good sort of slogans that get bandied about quite frequently. Yeah, so I think in terms of my social activities, also kept quite busy by three very busy kids, and yeah, try to engage in social activities with the family and the broader family as well. Yes.
Okay, that gives us a good understanding. Maybe I know you. I mean, you've got a CFA qualification,
Yes.
and there's a lot of people maybe not in investments or thinking about going into investments. Would you recommend that young professionals also pursue the qualification? Is there another qualification that you would also recommend? Yeah, and tell us about what are the differences that between the two that you recommend and the CFA.
Yeah. Okay, so I think that's a very important question, and one of the disadvantages of being in your 40s is that we didn't have access to the great career guidance at school. So when you're smart, everybody tells you become a doctor, become an engineer, or become an actuary. I think the actuaries were quite abundant back in the 1980s and 1990s because all the smart kids tended to go for that option. And clearly that option is linked to the perception of being successful. It's linked to the perception of being economically well off as well. Whereas I think there's a whole host of careers that people can be passionate about and also exploit their talents, that doesn't necessarily restrict them to actuarial science or to being a CA. And I know this is a forum for CAs. I must put the disclaimer down. I'm a failed CA, so I think we will touch on that in the next minute or so. But I think in answering your question, it's always difficult to give young people the correct advice because each person is individual. They've got their own talents, and I think what normally happens is peer pressure is obviously real, and young people find that my parents want me to be a CA. We've got a society that looks up to accountants and business people or doctors as being the ultimate sign of success. So I think that is a disclaimer. But having said that, I think having discovered the markets by accident, and we'll talk about that in a minute, I found that it's actually the knowledge that you gain and the life skills. I would call it a life skill. is so important that you don't need to look at the CFA or getting into markets as only a career. I think there's so much that the ordinary man in the street can learn from that process that can help them and benefit them in terms of their own finances, their own wealth creation objectives that transcends just a career. And I know it's a mouthful for an afternoon, but I think that is quite important. And the central message that we should leave your audience is that pursuing either markets or a career in markets doesn't have to be just a dead end job. It can be to the benefit of your economic well-being for the long term as well.
Okay, and you said we're gonna touch on some of the stuff again later, so feel free to chat about it now.
Yes, yes. So I think if you look at my career, as I said, I stumbled into the investment area by accident. So initially, I mean, I went the whole CA route at UCT, did my BCom, enrolled for the postgraduate diploma in accounting. I don't know if they still call it that. This is in the early 1990s. Unfortunately, I had some, so I had bursaries and scholarships, but unfortunately, some of that dried up. So I couldn't, pursue the CA stream to its fruition. But the irony is that when I got into the investment area, quite a few of the people that I trained and oversaw were CAs. So I think I didn't end up at quite a bad place. But before we get there, I think in terms of my career progression. As I said, my first sort of work experience was working as an accountant for a small company in Montague Gardens. And that was quite a rude awakening because the official title was assistant financial manager. But the day I joined, the financial manager resigned. So I became the de facto
About this
financial
one.
manager. So,
It
and in
happened so
effect,
many times.
and in effect, I could see why that happened because not that I want to blame anybody, but there were some irregularities, to put it mildly, that was happening. And so I was thrown in the deep end. I mean, fresh from UCT, never worked, in a professional work environment, and now suddenly I'm the financial manager. I had to oversee two branches, one in East London, one in Port Elizabeth. And that was quite, I think it was a great learning experience. I learned more in that just over a year at that job than I did as combines almost 17 years of schooling and university. And I think the character development and the temperament that I built up there has stood me in good stead to with subsequent employment opportunities. In particular, I was effectively headhunted by one of the larger asset managers. I don't know if I can name them, but people can see on my LinkedIn
Go for it.
profile that I worked at Alan Gray before. I spent about 10 years there. And as I said, I mean, the day I joined Alan Gray, I didn't know what the share was in terms of the real sort of application. Sure, I learned the theory, in terms of your finance modules at varsity, but getting exposure to the JSC was a fairly new experience for me. Up to that point, nobody in my family ever invested before. My father worked for the council for 40 years as a foreman driver, so money was hard to come by. So there was never the opportunity to have excess funds to play the market or to invest, for example. So yeah, it was quite a interesting but steep learning curve at Alan Gray. But I think I joined the industry quite a unique opportunity because August 1998 we saw the emerging market crash. At that stage, the largest crash up to that point since I think the 70s. So I cut my teeth in that market. And what was interesting then was that South Africa, in terms of RJSE, went through a period of rapid consolidation in terms of companies. So my initial job at Alan Gray was to set up the investment systems at Alan Gray. So I worked with the IT guys. Being an accountant, I had to translate accounting speak to IT guys, and likewise converse IT geek speak to accountants because I did some IT modules in my undergrad. So it was quite a unique place, and Alan Gray was transitioning to a new investment system. I spent some time at Orbis, the sister company, with their IT guys in London as well. So for a 23, 24-year-old kid, unmarried, single, traveling the world, first time on a plane, all of those first milestones was a very exciting period in my life. And I don't regret any moment of that. over time, I think, as I said, that's how I got into the markets. And the interesting bit was when Alan Gray asked me, "Do I want to be an analyst?" And I thought, "Geez, this is so easy. I mean, how difficult can this be?" Now, this is about January 1999, and CFA 1 gets written in June 1999. So they tell me, as a precondition, you need to do CFA. So I literally had about 2.5 months to study for CFA 1. Because by the time I accepted the offer, the CFA exams was almost upon us. So, and back in those days, there were no sort of help or anything. You had to go through the physical textbooks. These things like Schwester notes and study guides was quite a foreign concept. But again, the learning experience was quite unique, and yeah, I think quite career shaping as well. Subsequent to that, over the years, I've progressed in that role, became quite senior in the investment team, and subsequently, I've approached Alan Gray to think about starting Sharia funds, Alan Gray Islamic Fund, for example. At that stage, the late Alan Gray was quite active still. I used to interact with him when he used to come down from Bermuda to Cape Town. We spent quite a bit of time together. Back in the day, I used to prepare his packs. Now imagine a dot matrix printer, those perforated sort of printing papers. I had to print his graphs and print all of those specs, tear out the perforation, put it in a file, prepare his transparencies. I don't know if you remember those projectors with the transparency slides that
Yes, yes, yes.
you have to. So I had to prepare that as well, take him through the slides. So that was fun. Clearly, in today's world, everything is electronic. You do a PDF, you do a PowerPoint presentation. So yeah, I think we've come a long way since then. But my ambition was always to manage Islamic funds and to manage Sharia funds. And I think we need to spend some time talking about that part as well, because in my experience, especially when I left Alan Gray, I was a shareholder in the business. Unfortunately, I had to sell my shares in Alan Gray. But with that payout, I was looking around in terms of Sharia opportunities. And yeah, I think the offering was not up to standard compared to what you see in the conventional side. But more importantly, I think
I think there might be a little bit of a signal issue. Let me just see. Have we lost him? Apologies for that. I think we might have lost him. Apologies while we're just trying to get Abdul back on the screen. That's one of the vagaries of dealing with kids online, is that every now and then we're going to lose some signal.
Sorry, I don't know if I lost you there for a second.
I think we lost you there for a bit, but you were just explaining to us what you were looking for different opportunities from after leaving Alan Gray. I thought also that was quite interesting, because it seems like you like to change jobs.
Yeah. Mm.
With me.
Yeah,
Sorry,
sorry,
there
you
seems to
just
be
broke
some
up
problem
there.
with the signal. Okay, apologies for the signal. Can you hear me now?
Okay. I
Okay,
can hear you.
perfect.
Sorry about that.
Nice. Okay.
Yeah.
No, I was saying you basically you were telling us just after you left Alan Gray, and I was just saying that it seems like you leave jobs just before economic crashes, which is a interesting timing.
Yeah, I don't know if it's me or if it's the market, but the market clearly don't like my career moves. But yeah, you're absolutely right. I mean, I joined Kagiso just before the 2008 crash as well. So, and those were also interesting times. And I mean, to give your viewers a sense, I mean, coming from a company like Alan Gray, we back in '98, they just changed the name actually from AGIC, which is Alan Gray Investment Council, to Alan Gray. So there was a lot of brand building that needed to be done, but also Alan Gray didn't have unit trusts at that stage. So quite a few of the investment team members had to, pound the streets to go and market the Alan Gray Equity Fund. I think at the peak, Alan
Wow.
Gray's Equity Fund was the largest fund around. I think it's maybe lost that status more recently. Um, but yeah, I mean, that was quite interesting times as well. So, I mean, in terms of that business, we were 36 in the company. And we could all sit around one table over lunchtime at Alan Gray in their old building in St George's Mall. Today, Alan Gray is, I think, probably close to 1,000, employees.
Sure.
So yeah, it's obviously grown from humble beginnings. And likewise, yeah, sorry.
No, no, carry on, carry on.
So and likewise, when I joined Kagiso, I mean, Kagiso was also a bit of a rude awakening because your creature comforts that you get used to at a big company like Alan Gray, your tea lady bringing your tea, and all of those. Somebody doing your printing, somebody doing your filing, all of that you now had to do yourself. But more importantly, I think what was quite interesting is that the entrepreneurial culture that was fostered at Kagiso. To give you a sense, I mean, I've never got involved with fund setup or operational matters, and to effectively set up a unit trust fund from scratch, and to try and get seed investors and to try and market this fund was quite doing most of those things yourself, and you then appreciate once it comes to fruition what you've achieved as well. So in sort of April 2009, our funds were approved, and our Islamic Equity Fund was launched in July 2009. And today I mean, clearly it was a struggle and a scramble to get the initial seed money. It might sound like quite a little money, and it was only about R1 million that you needed to seed a unit trust. But it was sort of hard questions to ask. How are we going to get this R1 million from, and where are we going to get it from? So, but today I think we manage over 4.5 billion in Sharia assets. So in the space of just over 12 years. So it's come a long way. More importantly, the objectives that we set out, which is threefold. Firstly, to bring greater transparency to the Sharia market, to offer a product which can compare with the conventional market in terms of transparency, professionalism, client service, all of those metrics and good things that I learned at one of the best asset managers around at Alan Gray. And then thirdly, bringing transparency and lower Kagiso.
Okay. I think that there's a little bit of a delay, but I think it gives us a good understanding. Maybe for the viewer at home, especially the young professional who has no investment industry experience, but maybe they're interested in investments or they want to get into the industry, what advice do you have for them?
Okay. I think, me is what must I study? And I've been in the fortunate position of working with quite a few exceptional individuals over the last 2 decades. And what struck me is that it doesn't really come down to your background or your undergrad degree, for example. I've seen people from social studies to actuaries. I've had actually the interesting tidbit is I've had maths professors be my trainees. So the one point that I forgot to mention is that I ran the training. So I initiated and then ran the trainee analyst program at Alan Gray, and we continued that program at Kagiso as well. And it's always interesting to take people from diverse backgrounds, professors in maths to graduates in social studies, for example. And the one sort of common trait or success factor is really it boils down to two things: hard work and a genuine interest in markets. If you have that, then I think you will be successful. And if you don't have that, you can be, a highly educated PhD, and you will not be successful. Or you can be, cut in the wool sort of CA, CFA, etc. But if you're not genuinely hardworking or into markets, then you can be, you'll have suboptimal outcomes, to put it mildly. So the advice I would give young people is read up as much as you can. I think reading is an underappreciated skill, and it's something that in today's time with millennials and social media, our spans have decreased substantially. I mean, I look at my own kids; they can't, concentrate for more than 5 minutes. So reading takes, a lot of attention, especially if you want to read with understanding. So that is by far the most important skill you need to develop as an analyst. If you can master that, and if you have a genuine interest in markets, and companies, that is by far the most important thing for you to be successful in markets as well.
So genuine interest in markets and the willingness to learn and read. Okay. So everybody should remember that at home. If anybody's got any questions for Abdul, please add it to the comment section and we'll try and answer them towards the end. Um, you also mentioned that, look, you've been in the industry for over 23 years. There's been lots of change. Are we going in the right direction and are we making enough progress?
Again, a good question. I think let's talk about South Africa. I'm not, I can't generalize too much in terms of world markets, but in South Africa, I think there's two elements here. There's obviously the general savings culture and environment, which I think, I mean, the one benefit that we have as a country is that we've got a very developed savings sort of culture and environment in terms of both the regulators and developed markets, our capital markets. I mean, our JSC, stands out as being one of the oldest exchanges. It's also quite substantial in terms of metrics like your stock market value to GDP. So that just emphasizes the point that savings is a strong culture in South Africa. So it's very easy for anybody to start saving. You've got various platforms from the likes of easy equities to direct unit trust investments, for example, to get exposure to. So I think that certainly is in place, and that creates an environment that we are on the right track. Where it gets complicated is if we start looking at human development and the opportunity set around that. And then secondly, and linked to that, is the capital markets itself in terms of fostering entrepreneurship that will enable more companies to list. And I think that's where we need to do a lot more work. I think there's a lot of businesses out there that could benefit from stock market listings. But I think there's a perception, whether it's real or not, that it's too onerous, it's too cumbersome, and access to capital is too limited. So we've got this dichotomy where there's a lot of savings pools and liquidity on the sidelines, but limited opportunity set in the local market, because we haven't seen. I mean, 1998 was the last period that we saw a significant amount of listings. So that culture of new listings and fostering new companies and new entrepreneurship, I think, is something that we need to work on as a country, and that will enable more companies to list and give our savers greater access and opportunity and options as well.
I guess that's a good idea. This is one question that I like to ask all my guests. What is one piece of advice you would give your younger self?
Read more. It's a
Short and
simple
sweet.
thing, but yeah, I think, the one, I wouldn't call it a regret, but the one thing that I always, feel a bit guilty about is that I haven't spent more time reading, especially, publications at the time. And I think if I look back at market crashes, every market crash gives you sort of telltale signs that the crash is coming. You just need to know where to look and what to read. And I think that has been critical. And the one thing that the markets have taught me over 23 years, it's so much easier and better to not lose money than to make money. Because by not losing money for your clients in a market crash, you are so much better off as a starting point. Because from there to grow, you just stand out in terms of your performance. And it becomes, obviously we don't have the time, and I can't put up PowerPoint slides for you here, but I mean, there's compelling evidence that suggests that if you can avoid big losses, and I think the likes of Warren Buffett always says it, try to not lose money. If you can avoid losing money, you on the right track, and you're so much better off than the general market, especially when markets decline. So and reading is linked to that, because if you can read the right materials, have access to the right sort of sources, um, I think it does put you in a better position to avoid capital losses. And from there, you just stand out and you can actually make significant amount of money for your clients. So again, a long answer, but it boils down to reading and reading more as well.
Oh, correct. That's great advice. Let's see. Okay, we've got some questions coming in, so let's just move over to the. Got a question from Lee. Lee wants to know: do you think a market crash is on the horizon, locally or internationally? Not a crystal balling, but give us your
Yes.
assessment.
Yeah. Okay. So that's a very important question, and something that does keep me awake at night, because we've got substantial investments. Yeah, my wife is invested in our funds, so I have to answer to that higher authority as well. So if there is a market crash, I'll definitely hear about it from my wife. So, so to answer the question, if you look at what has driven markets, if you look at what has driven markets, it's been liquidity. We've had more inflows in this year than the combined inflows in the US market over the last 19 years. And that's a scary stat, because it means that, from Bitcoin to equities to all asset classes, the rising tide has been, lifted by liquidity. And as we know, the Fed is now in the tapering cycle. Interest rates are at multi-decade lows. So, unfortunately, Lee, the answer is that there is probably a market. I wouldn't call it a market crash. I've got investors here, so I don't want to scare them off. There's likely to be a market correction at some point. And certainly, we think that valuations are high. The drivers of the market are starting to turn from tailwinds into headwinds. So I do think that internationally, certainly, and in the US in particular, it's probably prime for a market correction. Locally, it's a bit more nuanced, because our market actually, the bulk of our market are companies that just happens to be listed here, and they tend to make most of their money offshore. They benefit from a weaker currency, and our currency is the self-correcting mechanism. So in a scenario where international markets correct, you will find that the currency will weaken, and that will buffet and certainly protect some of these international companies in terms of their share prices. Also, our starting valuations are a lot lower compared to international markets. So I don't think there's necessarily a market correction or severe market correction on the local market. But having said that, past experience shows that markets correlate very strongly in down markets. So if there is a US correction, then it will invariably affect our market as well.
I think that's a great summary. We've got one more question coming in through from Jonathan Sikombe. How much is technology impacting your work and the way you make investment decisions differently? Great question.
That's a great question, because, if I reflect back over 23 years, as I've mentioned, from dot matrix printers to OLED projectors, we've come a long way since then. Certainly, technology has certainly made the admin side of things very easy and much more efficient. So, I look back when I started out, it took us 4 to 5 months to write an investment report. Today, you can write a report in 2 to 3 weeks. Not that you not covering all your bases and you're not being thorough. It's just that access to information. And I mean, back then we had to go to a library, go look up various publications, look at newspaper clippings, and try and find this. Each company had a file which you had to go through, sitting in the library at long hours, for example. Today, everything is online. You can get access to the information. We've got a great system at Kagiso where you can do searches on publications, investment reports, etc. So definitely, technology has made my work a lot easier in terms of the immediacy of access to information. But also, it has complicated things in the sense that more people have access to the same information and almost at the same speed as you. If I look at the information asymmetry that we had in 1998, The 1 year, Alan Gray, and referring back to the company, had a massive alpha year because we had significantly higher and superior information and information asymmetry. Today, a lot of that information asymmetry is dissipated by technology and the immediacy of information dissemination. So that is probably the downside for alpha, and you need to work a lot harder to generate alpha for your clients. So it probably balances it out. But again, there's still room for people that work hard and have a very robust and active investment process to generate alpha for clients as well.
Any last few words or anything that we didn't discuss that you'd like the audience to know?
Yeah, we didn't discuss the running, but the less said about that, the better. But yeah, I think I want to leave your audience with two messages. Firstly, you know, not having had exposure to equities and investment markets until I joined an investment company, the amount that you can learn and the amount of self-study that you can do to benefit your own economic circumstances is massive. So I know your audience comprises mainly CAs, but for CAs out there, you've got the critical skills and you've got the knowledge base to actually not only catch a fish, but to actually fish for yourself and for your family and for your dependents as well. So just do a bit of reading, do a bit of research. I think the one thing that investment managers are always scared of and wary of is giving too much information to clients because they will effectively bypass the manager and do it themselves. I think that is a myth. As you can see, always I'm gray already. I spend my day job doing this. I think CAs have auditing jobs. They've got other things that they have to do, so they can't dedicate the same amount of time necessarily that I can to this. And it's all about your investment process, your ability to work hard. So that's the one aspect. And then to your Muslim audience, I think I'm on a mission. My pet project, as I would like to call it, is to convince people that Sharia funds, firstly, is for everybody. You don't have to be Muslim to invest in a Sharia fund. I think Sharia funds are actually very good ESG funds and socially responsible funds, and we've certainly proven that through performance that our Sharia funds don't have to stand back for conventional funds. But more importantly, my central message to the Muslim audience is that you don't want to be in a situation where you about to retire and you now have a moral sort of dilemma in terms of trying to determine how much of your funds were compliant and how much of it was non-compliant. One can rectify and remedy that through converting to Sharia compliant funds before retirement as well.
That's a good way to end off. The show has been live on YouTube and will be available on the podcast tomorrow. If you're watching on YouTube or listening on the podcast and you feel it's added value to you, don't forget to like, subscribe, and click on that notification bell so that you get automatically notified when the next episode comes out. Abdul, thank you so much for your time.
Thank you.
Thanks everyone for joining us for another episode of Two Ways to Skin a Cat.